Good morning, everybody. Welcome, welcome. Thank you for joining. I know some of you got in early, got the coffees ready, and rearing to go. So that was great. We're just going to wait probably an extra minute to allow those just starting the day to get in. There are people sort of joining as we go. So we'll just hold fire for a minute, then I'll talk a little housekeeping, introductions, then we'll get on with the session. So just bear with for an extra minute, if that's okay. I always wonder whether I sort of welcome people as they come in to name and shame the people that have arrived a minute afterwards, but it's probably nicer not to. Right, we're at 9:01, and I know time is precious, and to get through the slides today, it has historically taken a full hour, so we will get cracking. So as I say, welcome everybody. Just a little bit of house admin. This is recorded, so we will be able to circulate around the video, and it'll be on our website as well. As mentioned, it tends to take about an hour in total. There is Q&A, so please do use that, but I can't promise that that I'll be able to respond during this presentation, but we absolutely will get back to you with comments afterwards, and we'll drop an email round. So do send in questions, or obviously email myself afterwards if there are any questions that pop into mind. The slides will also be available, and we will send round, this can form part of your CPD, so we will also send round a certificate for those that stay the full hour to have, so you can use that for if you're a member of the ACA, ACCA, and otherwise. So we will also present that. My name's Dickon. I am an audit partner here at H.W. Fisher, part of the Summer Group. So I am London-based and work with a number of the offices across the UK as part of the wider Summer Group, and sit on the audit management board for Audit Co. We are going to spend our time today talking about a bit more of a deep dive into leases. Hopefully some of you join a webinar that was sort of high level look at leases and revenue. The aim today is to really sort of get into a couple of worked examples around some of the judgments, some of the estimates that are coming up, and actually looking at potentially in a very sort of micro way what the impacts are with the changes. So really just focusing on the leases. Some of it will go back through, which I'm sure will be familiar to a lot of you on the call. And then, as I say, trying to bring it a little bit more to life with some worked examples. There are a lot of things to be thinking of at the moment. We'll be talking about some of the bits beyond financial reporting, how this could impact you, stakeholders, and why you might want to be thinking about your changes now, your time and ability as a wider team to be able to do those in the near future. So we'll go through some of those. So the FRC has aligned FRS 102 leases to IFRS 16. That is the intention with the FRS 102 changes in 2024 officially, although they come into force as of 1st of January 2026. There are a number of changes. We are only looking at the leases today, but the overall reason behind all of this is, again, to try and create a more unified, consistent way with IFRS 16. So starting at the very beginning, obviously the first thing and the key part of a lease is determining whether you have a lease. The fundamental change now, once you've established you've got a lease, is there is going forwards no such thing really as an operating lease. everything is going to be on balance sheet like a finance lease has been historically. The powers that be believe that this is clearer and easier to the readers of the accounts to reflect possibly some of the benefits you're getting from the leases, that there are assets, and also to make it clearer about the liabilities despite the historic disclosures around operating leases. Please don't bash your auditor. This was not their decision, but that is, it is, the idea is to make it consistent with IFRS, but also clearer to the readers of the accounts. So I think that the key part is, the definition of a lease. So this is a contract or critically part of a contract that conveys the right of use, the right to use an asset or the underlying asset for a period of time in exchange for consideration. So the lessee conveys the right to control the use of the underlying asset. So that is, obtain substantially all the economic benefits from use, or direct the use of the asset. So some of this and this initial nuance, it seems very obvious for probably 95% of our sort of leases and contracts, but there is a judgment at that first sort of part, is whether or not it is a lease, and whether there is an identified asset as part of that. So it could be specific in the contract, or it could be implicit. So this is the piece of re-looking at some of the contracts that you may have. Actually, is there something in there that's implicit in the contract? Then the identified asset. So where we talk about on the control and the use of the underlying asset, and the rights to that asset, things we've got to think about is, actually, we may have got a contract. It may look like a lease. Do we, as the lessee, does the lessee have the rights to that underlying asset? And some of the areas where it might not is that supplier's right to substitute the asset to is quite key. So when we're thinking about, has the lessor got the ability to change the asset at any time? So things there that may look into. So has it practically got the ability? So it might be, I don't know, if we've all gone and rented a car from Hertz on holiday, we always tend to book one online, and when we get there, there's very much a very different car that you actually sort of rent. So ability to move assets, actually, has it got the ability? Is it practical to do so? So for example, it might be a lot harder to swap in and out of an office space. You can't suddenly just magic up an office space in the same location, all these kind of things. So thinking about, actually, is there the ability, and is it in that contract that they could swap out and change that asset any time? And also, fundamentally, would it be benefit economically from doing so? So sometimes you could, but it would come at large costs and clauses there. But it is something to think about, because some of the contracts, some of the leases that would, on the surface considered to be a lease, might actually not. There might not be that underlying asset and the rights of use of that asset. So if that is the case, you account for that non-lease component separately and allocate on standalone prices based on the contract, or otherwise sort of estimate those parts that aren't part of the lease, and you just deal with that upfront in those contracts. So it's really, that's even at the starting point with these leases, is having a look at those, considering, actually, fundamentally, is it a lease, or is that something else that we've acquired? There are two exceptions to this new rule, that we treat everything as a finance lease. So, historically, we've got the operating lease with the disclosure in the background. You treat that cost on an annual basis. Now we're bringing everything on those two expedients, the two exceptions: short-term leases and low value assets. So these are the two exceptions to the rules. So what we're saying here, short-term leases, anything 12 months or less. So we've got anything, and when we're starting this and when we're thinking about this, just because you've got a 5-year contract, say coming at the end of 31st of December 2026, that's effectively only got 1 year left at that time, that would count as a short term, so it doesn't matter. The original term was 5 years, that final term is 12 months. So if you've got a lease that's 12 months or less, that counts as a short term lease. If you have low value assets, now a little bit again straight into some judgment. What are your low value assets? FRS 102 has actually been a little bit more prescriptive. I think it's learned from the changes in IFRS. So you've got your short-term leases. They can be ignored. You don't have to bring them on balance sheet because it's just not worth the time. They go through as that sort of cost in the year. You will have to have an extra disclosure at the back on the amount outstanding for short-term lease, and similarly low value assets. Now, low value assets, the key of what FRS 102 is pushing you towards, and IFRS similarly, is that the low value asset is not based on your materiality. So the challenge here, I suppose, if you were a massive global organization, you might see that maybe having a car is absolutely clearly immaterial to the readers of the accounts, therefore it's a low value asset. Now, effectively, the standards have kind of said, well, we can't have this mix. That car, the value of that might be actually material to somebody else, so that low value isn't the same. So here, I think when IFRS came out, and the standards sort of came out about 8-9 years ago, they hinted to $5,000. Here they haven't put in a sort of a monetary amount. They've avoided that, but they have given examples of where things would not be low value. So cars, vans, buses, things like that. So, if you're big manufacturing, sort of the forklifts, the telehandlers, individually to your accounts, they may seem immaterial, but it's about thinking about it in a wider person. The ICAW always refers to these kind of things as, what does the person on the bus think? Is it of high value to them or low value to them? So you can't think of it in context to your own materiality. You have to kind of put a sense check on it. There is no absolute definitive. They've given what examples might be for not being low value assets. As I say, IFRS 16, when that came out, did talk to $5,000. That's the kind of sort of piece in there, is actually individually, is it low value to anyone, not just us as a firm. So there is judgment, and you will need to document your consideration of low value assets. There is a policy around what you would consider. You need to probably document that, and that might sort of update in your accounts, but also thinking about how you're tracking low value assets if you have got that policy, and what does that mean to capitalization, all these other pieces. So how are you going to track it? So it is one to think about, depending on the purchases and things that you make, but again, immediately a bit of a judgment there on what you're defining, how you're defining it, and how you're going to track it. So probably the short-term lease, fairly straightforward, 12 months or less. The actual examples of low value assets, a little bit more judgmental, and something that you'll have to consider, document, look through your registers, look through your leases. How are those, how have they got? Again, when it comes to the financial statements at the end of the year, there is a disclosure at the back that you will have to put, and you can combine low value and short-term leases, and you just have to put a kind of almost like an old operating lease disclosure at the back there. So again, first judgment, is it a lease? Is it a contract? Second judgment, can you use any of the expedients from there? Next judgment, and I'm sort of leading into this one to try and get through some of those kind of initial kind of thinking points before we get to some of those worked examples. But the premise being, how do you value that lease? And it's the net present value of the future lease payments. So a key consideration in there is the lease term. So this holds quite a lot of judgment, going back to what we might have as break clauses now. A lot of firms have used those as, my operating lease disclosure goes up to the break clause because I've legitimately got that break clause. It gets a little bit more complicated under the new sort of guidance. So the lease term is the aggregate of the non-cancelable period of the lease. So that's pretty obvious, the non-cancelable period of the lease, or we think it's pretty obvious. There are some challenges in there. And then periods covered by the option to extend the lease if the lessee is reasonably certain to exercise that option. So that you don't have to absolutely commit, but you have to be reasonably certain. Are you going to go beyond that break clause? Are you going to use the full term? If so, that is included in the lease term and the initial calculations. So and then periods covered by an option to terminate the lease if the lessee is reasonably certain not to exercise that option. So what does that mean here in reality? You might have a 10-year lease with a 5-year break clause, a pretty kind of standard idea here. Now, you've got 5 years as a non-cancelable period. You know that 5 years is certainly going to be part of your lease term because that is up to the first break clause. The next judgment then is, in your lease term, are you at this point in time reasonably certain that you are going to extend or not extend your lease? Now, the key here is, again, it is quite a big judgment. You are going to have to document it. There have been some considerations here which we talk about. Is you're going to have to explain why you're reasonably certain you might not exercise that extension or the use of the additional 5 years. So, the obvious starting point is there a break clause? Areas to think about when you're making that decision is, how much time and effort have you already spent on that lease? Say it's a property, have you spent a lot of significant improvement? Is it in a brilliant location? All of these kind of things is, if that's the case, it probably isn't economically worth your while to break in 5 years. It would indicate that you're there for 10 years. If it's in a really good city centre spot, or a really good sort of place for factories or otherwise. So thinking about, actually, we're not likely to move. We've invested heavily here. It's to go and find somewhere else in the same location, the same quality, whatever it may be, it's unlikely. Therefore, we at this moment, and it's always at that moment, we're expecting to use the full term. We're not necessarily going to break it. So there is that immediate kind of significant judgment, because that makes a big difference here. Because working backwards to your net present value of 10 years versus 5 years can be a significant different. So that's where, again, the standards, given some prompts, and those key obvious ones that are the reasonable cost effective to break. Is it that you can go and find somewhere else and do something else, or things like, have you spent a lot of money in doing up the leasehold and those pieces? So and what is the importance of that? The asset that you have, is that important? Is that key to running the business? Is it some machinery that actually, without that machinery, is going to really struggle? So you're going to use that machinery for that whole time. So that is your next judgment. Again, this is going to have to be thought about, documented, evidenced. You can't just sort of skip through to, yeah, we're in. Is why are you using the full lease rather than the break clause? Why are you thinking that you'd use the break clause, not the full lease? So you're going to have to document it down, consider it, and make sure you've got this kind of rationale and thought behind it. So again, there is a bit of work to do here, depending on the number of leases you've got, the type of leases, and sort of the break clauses involved in those. So do have a think about that. That lease term is critical. We're going to have some worked examples around that sort of lease term to think about that cancelable and renewable leases, because there is a bit of a nuance on who's got the rights and where. So looking at the standard now and assessing the length of the non-cancelable period of the lease, the entity shall determine the period for which the contract is enforceable. a lease is no longer enforceable when the lessee and the lessor each has the right to terminate the lease without permission from the other party, with no more than an insignificant penalty. Now, this is important when we're sort of thinking about that break clause. Say, again, going back to the idea of a 10-year lease with a 5-year break clause. Is that 5-year break clause, is it the lessee and the lessor have the right to cancel at that time, without needing a huge amount of permission from the other party, or any sort of major penalty clauses? So if the lessor and the lessee have the right, then that means that that there is no longer an enforceable right there. So that is quite important. Again, looking at those contracts, thinking about what it is there. So then, where the lessee has the right to terminate a lease, that right is considered to be an option to terminate the lease available to the lessee when the lessee is determining the lease term. Conversely, where only the lessor has the right to terminate a lease, the non-cancelable period of the lease includes the period covered by the option to terminate the lease. A lot of jargon in there, but this is the point of going 10-year lease, 5-year break clause. If the lessee only has the right to terminate the lease at the break clause at 5 years, then the enforceable contract is the first 5 years. The judgment then comes: do you reasonably expect to use the next 5 years? If the lessor has only the right to cancel at 5 years, and the lessee doesn't have any rights, then actually, from a lessee's perspective and what goes on to the books, actually the whole thing is enforceable, because the lessor has the right to make you use that 10 years. And again, if there is that option that either one can cancel and there's no implications, then actually this becomes a non-enforceable contract at that point. So, trying to just run through a couple of worked, sort of bringing that to life with some worked experience examples here. So Sid Industries enters into a contract to lease an office space from LHB Co Limited. The contract has an initial non-cancelable period of 2 years with an extension for an additional year if both parties agree. There is no significant penalty for either party if they do not agree to extend for the additional 3rd year. So we've got a non-cancelable period for 2 years, option to extend for a further year if both parties agree, no significant penalty. What does that mean? The initial 2 years non-cancelable period meets the definition of a contract because it creates enforceable rights and obligations. The 1 year extension period does not meet the definition of a contract because both parties to the lease can individually elect to not extend the arrangement without any more than an insignificant penalty. So therefore, at the commencement of the lease, neither party has the enforceable rights and obligations beyond the initial non-cancelable period. So in layman's terms, what does that mean to us? It's the same as going, well, in theory, you could look at it going, there's a 3-year lease with a cancelable period after 2 years. Both parties have the right to not extend or to cancel after 2 years, which means there is no enforceable rights and obligations for that 3rd year. So as the lessee, we are only going to bring onto the balance sheet the asset for 2-year period at that point. Even if we're hoping that it's a 3-year term, at the initial outset, we will only bring it on for 2 years because ultimately the lessor has some of that right as well. So we will bring on the net present value of future lease payments over the 2-year period. So that's when it's a sort of a joint. So then Lyra Limited, the lessee, enters into a contract to lease a warehouse from Twizzler Properties Limited for 15 years. The lessor has the option to terminate the lease after 6 years. So here, the fact that the lessor can terminate the lease after 6 years is ignored when calculating the lease term. So yes, the lessor could, but as it stands for the lessee, The unconditional obligation to pay for the right of use asset is for the period of the lease, and so effectively obliged to make payments for 10 years unless the option to terminate. So what we're saying here is the lessor being able to cancel it has no impact on the lessee. You don't know at that time. The expectation from you is the length of that lease. If the lessor decides after 6 years, then you'll have to account for it then. But at the initial outset, the lessor only having the rights to break the contract doesn't impact the lessee in bringing on that asset and liability. You'd have to do it over the full length of the period. So therefore that is where we see so again, it's that bit is trying to get to the piece of if it's joint or if it's lessor owned, that creates non-enforceable. You don't take into account the lessor part. The lessee is the full lease then, because it's not your choice. You can't decide, actually, what, I feel like I'm going to move out of here. If it's joint, again, it's that aspect that there is no sort of choice in this, so you ignore that. So there are some decisions there, and again some judgment. So this is what hopefully we're trying to get across in this webinar. It's not all about just jumping to the net present value of future lease payments and the right of use assets. We've got to get some judgments there first. Is it a contract? Do we have the right? Are we using any expedience? Is it a short term? Is it a low value? Right. Okay. We've ticked off those kind of things. What is the lease term? If it is a lease, what do we need to say? What are the factors there? How can we do it? Will we really use the break clause, or is there enough in there? Is this asset important to us? Is it, if we invested too much, that actually realistically we're not going to break after 5 years, we're going to go for the full 10 years? That's why we've got it. So all these judgments lead us to that point. Then we've got to get to the actual accounting treatment once we've kind of considered those factors and thought about those. So at the commencement of a lease, a lessee shall recognise a lease liability at the present value of the lease payments still to be paid, so the future lease payments, and a corresponding right of use asset. So in a very vanilla world, once you've worked out the lease liability, if there's no other factors, the right of use asset will be the same at that initial point. As ever, things to think about in the measurements and judgments of that lease liability. So the lease liability should be measured at the present value of the future lease payments outstanding. So very vanilla contract, you might have £100,000 a year for 5 years. So that is, you're going to bring on that £500,000 discounted down to the present value. So that's very vanilla. Other factors to think about: any variable payments, but it's not any variable payments. It's any variable payments that are dependent on an index or rate. So are there a measurable index or rate that they're associated with? So in your lease contract, you might have, it is £100,000 a year, but also it will go up by the consumer price index. If that is the case, you need to consider the CPI at that time, and think about that and apply that to the future lease payments, and then that will be part of your total cost. So you absolutely bring in there those variable payments. Where you can't bring in variable payments is potentially you are leasing a shop or a cafe or something like that, is and you might pay additional amounts depending on the revenue generated in that shop or cafe or restaurant or whatever that sort of place is. You don't know what your revenue is going to be. There's no tangible P's. You can't really track it to an index or rate. So although there might be some additional variable payments at the time and the inception of the lease, you can't include those because there's nothing to track it to. So those variable payments are not included, and they are dealt with on a year by year one-off sort of piece. So you can only include variable payments if they are dependent on an index or rate. So other things to think about, residual value guarantees, purchase options, sort of prices that will be factored in, and potential penalties for terminating leases as well. So there are some other ones, possibly less common, that need to be thought about in that initial value up front. But ultimately, that variable payment one is quite key to consider, because it's only in certain circumstances, although you have to think about any variable payments, but you'll have to sit there again. There's a process here. You've got to make sure you've documented, you've considered, you've thought about the contract, you've looked at it, you've gone, okay, well, here are potential variables, and documented why you're either including it or not including it. Once you've worked out what potentially the lease liability and those future lease payments will be, and what can be included in there, you obviously have to discount it down to its net present value. Now, as everybody knows, everybody hates, a discount rate. How do we get to a discount rate? 10% is remarkably the world's favorite discount rate. But what does this mean? We've got a discount rate that FRS 102, they've tried to be a bit more helpful on this, because everybody's aware that it is a little bit harder. So the lease payment should be discounted using the interest rate implicit in the lease. So it might be that there is a rate in your lease and in your contract that is implicit. So perfect, use that. If it can't be readily determined, so that implicit rate, what do we expect from that lease, then there are two others. So it's the incremental borrowing rate or the obtainable borrowing rate. So there are some other considerations here. I've looked at this a few times. It's sometimes sort of it does sort of confuse me what we talk about, that incremental versus that obtainable rate, because they're very similar. If you kind of read the definitions in FRS 102, the rate of interest of a lessee would have to pay to borrow over a similar term and with a similar security. That is a key part in the incremental, the funds necessary to obtain an asset of a similar value to the right of use asset in a similar economic environment. That is the incremental. The obtainable, the rate of interest a lessee would have to pay or to borrow over a similar term, an amount similar to the total undiscounted value of lease payments to be included in the measurement of the lease liability. It's in the detail, it's in the nuance, but I suppose the obtainable rate, if we're looking at that, is basically if you were to go out to a bank and ask to borrow, working on our worked example, if you were taking a lease for £100,000 a year for 5 years, so a £500,000 lease, how much could you go and borrow? How much would it cost you to borrow that from a bank? Like the obtainable borrowing rate. So there is a similar amount to the total undiscounted value of the lease payments to be included. So you're just going out, this is us as a business, we need to borrow £500,000. What is that? What is that rate? Now that would be the obtainable borrowing rate. The incremental one, a little bit more judgmental, little harder. So what do we mean by there? So it's how much would you have to borrow using, say, that asset, if you had that asset as security. So you already had that asset, so you were borrowing against that. So how much would you be able to borrow at that point to obtain an asset of similar value in the current economic environment? So the incremental one differs slightly, because you're almost using it saying, well, actually, potentially it's a lower risk situation. We have this as an asset, as that you can almost say, well, we've got more asset, we're lower risk, we've got this to support the loan. So that would give you your incremental rates, so getting those funds necessarily to obtain an asset of a similar value of the right of use asset. So you're also sort of going, actually, what would it be at this stage? So there's a lot more judgment in the incremental. It's a lot more complicated in many ways, because you're kind of having to rejig as though your balance sheet, to rework it, going, yeah, absolutely, if we had this additional 500,000 discounted back down to today's value, say £400,000 asset, how much could we, you know, borrow on a basis to pay those amounts? So it's probably comes at a, generally speaking, rule of thumb, don't hold me to it, but a rule of thumb, the incremental is probably going to be less than the obtainable, but it's a lot harder to work out what your incremental one would be. The obtainable one is a little bit more vanilla. It's a sort of FRS 102 brought it in as a little bit more of an ability to kind of just, I can easily go and find that. If I needed to borrow £500,000 as a business, how much, you know, who would give me that, and what would it cost? So it's a lot easier to obtain. The incremental takes a lot more judgment. You've got to factor in different things to get to an interest rate. The bank might not be able to give you an obvious incremental sort of borrowing rate. So there is a lot more judgment involved. The upshot being there is probably a lower discount rate for incremental than there is obtainable, but you have both options. That's to use if there is no implicit interest in the contract. The right of use asset, the cost measurement. So the initial measurement of the lease liability, that is the very vanilla contract. No other excitement in there. You will just recognize the asset will be the same as the net present value of the lease liabilities, and then be one from there. But sadly, as ever, there's the devil's in the detail. There can be some additional things that you would have to consider as part of these part of these measurements. So any initial direct costs incurred, that would be included. An estimate of any obligations for costs to dismantle. So your dilapidation suddenly becomes quite important here. So you would factor that in and bring that into your right of use asset. There, this could start creating a difference between the value of your right of use asset and your liability obligation on the balance sheet. So if it is the absolute most vanilla contract, you'll have a net zero impact on your balance sheet. The net present value of the lease liability will be your right of use asset on day one, and change from there. But there are other things that you need to consider. So I was having a conversation this morning. Dilapidations, those kind of things, often ignored at the beginning of a very long contract. They can no longer be ignored at the beginning of a long contract. You need to consider it. It needs to be part of that right of use asset, and there will be an unwinding in that and consideration in there. So there are bits now you do need to read up front and consider. And again, it might be a judgment. It might be that you haven't made significant changes to the leasehold property, so therefore your expectation at this time is that there are no real requirements to make good because you haven't changed anything. So again, it'll be another judgment. And I think this is the bit with this webinar and what we're trying to get across with it. There are judgments everywhere you look. High level, it can look quite straightforward. Unfortunately, you will have to look at it, and each contract may be different. Each lease, if you've got a number of properties, may be under different terms. You do have to think about them all, look at them all. You can't sort of just assume that they're all the same. So the subsequent measurement is the lease liabilities reduced by the lease payments. Fairly straightforward. The one key bit that will differ and has wider implications is it also then increases by the unwinding of interest. So we've discounted that future lease payments. We've discounted it down to the net present value as today, which means we've got to unwind that, and that unwinding of the liability will come in as a finance cost effectively. So that will come in. So that would be your subsequent measurements of lease liabilities. So the expected for assets is the measure using the cost model. So you can measure using cost, revaluation, or fair value. a lot of people will likely use the cost, and you will unwind that in a similar way as a fixed asset. You will depreciate it over the period of time. So you can remeasure, and they are done through lease liabilities and right of use assets. So change of an assessment of the lease term, you would change both. There again, as ever, there's a bit of nuance in there, but in theory, high level, you're going to unwind your lease liability and offset it by payments made, and your right of use asset is probably going to be a little bit more straight line. So I think I just pause for thought there. I don't have a glass of water. We're going to now go into a worked example and try and do this in detail for the last 20 minutes of this call to try and bring that all together. And what does that mean? So I think running back and just recapping where we've got to, and the number of judgments and the documentation that you will be needing, you know, to make sure you don't sort of shortcut to going, well, this is what we've done, is first and foremost, have you considered, is there a contract? Is there an underlying asset? Again, thinking about those bits was, does the lessor have the right to substitute? Can it practically substitute? You know, actually, does the lessee has the control and over that underlying asset? So you got a judgment there. Then you're kind of going, well, what is that lease term? Absolutely, loads of judgments there, potentially depending on the contract. Who's got the right to use the break clause if there is one, or extend if there is an extension, as the opposite way round. Have you got, you know, reasonable expectation to extend or use that break clause? So again, defining it all down, making sure that you've thought about that. Are you using any of the expedients? Are you using, it's a low value? What is your low value? Have you created now a policy that assets considered under this amount are considered low value and treated as such? So putting those low value, making sure you're maintaining a register of those, because there is disclosure in the back end that you'll still have to use for that. Short-term leases, using the expedient there. Again, you'll need to just keep track of those, but it is one of those ones that is a little bit more straightforward, I suppose, on those judgments. So you've made it all the way to those bits. Now your initial piece, what discount rate are you using? How are you evidencing a discount rate? You know, there is immediate thoughts of going, right, well, actually, you know, I don't want to go and find a discount rate. I'll just, you know, make one up. How are you coming to that discount rate? You know, how are you defending it? Why is it the right discount rate? So it might be as straightforward as it's in the contract. It might be as straightforward as you've got a loan for a similar amount that you've recently taken out, and, you know, therefore that would be reflective. It might be that you've just got good relationships with your bank manager and you've asked them for a rough guide of where would they sit. Now, there are sort of ways you don't want to, you know, I'm sure spend loads of money on it, but you've got to be able to evidence your decision making when it comes to your year end, and make sure you've got the right discount rate there. Once we've done that, how do we work it out? How do we go from those sort of pieces? So we're going to create the net present value of our future lease payment. We've got to think about other things like variable costs. So is it going up by CPI or RPI? If it's something to do with sales or otherwise, can't include it. So are there any variable costs or other pieces that you need to include in that initial calculation to unwind? And from a right of use asset, vanilla will reflect the lease liability, or are there some complications in there? Are there some additional costs to bring to use? Is there some dilapidations and things that will just need to be added? So things to think about. In our worked example, then, going through this, Colonel Limited signed a 10-year lease on 30th December 2024 to lease a bonded warehouse facility and offices. There was a break clause attached to this lease whereby Colonel could exit the lease after 5 years. Lease rentals are £180,000 per annum, payable on a monthly basis. The lease previously met the operating lease criteria, and the accounting reference date is 31st of March. So no upfront fees were payable on inception of this lease, and no lease incentives were granted. So on the 1st of April 2026, the company could borrow money from a reputable high street lender. And with my audit hat on there, again, when looking for examples, please do use a reputable high street lender at 8% per annum. The lease payments are profiled as follows. Lease rental payments per year, £180,000 payable per month, which is effectively £15,000 per month. For the sake of time, effort, and income publications, VAT, equivalent sales tax have been ignored to just work through this. So ultimately, we have entered into a contract that previously met the consideration of an operating lease. We entered into that 30th of December 2024. It is £180,000 per year. So that's where we've kind of got to. What does that look like? So in the years to 31st of March 2026, the following lease payments would be recognised in profit and loss, as the lease was previously accounted for as an operating lease. So we went into it end of December. So for that first 3-month period to March 2025, we've got £45,000 that would have gone through the profit and loss. To the 31st of March 2026, £180,000. So lease rentals not paid at each reporting date are then shown as below. So initially treated it as an operating lease, went through to the P&L. Now we've got to change it. Now we've got to think about what do we do with the remaining pieces. So transition to FRS 102 2004 is accounting as at 1st of April 2026, because we are a March year end, just to add a little bit of excitement to this. So we've got on that date the committed lease rentals, unpaid lease rentals, amount to £675,000. We know we can get from a reputable lender an 8% deal. So our discount rate here is 8%. What does that look like? So underneath there, we've got the table that's showing that calculation. So we've got effectively £675,000 outstanding. But what does that mean in its present value? So the present value of the future lease payments, we discount it down, and that means that actually our present value at this time is £563,000. So we've looked at it, £180,000, and obviously that last one is only £135,000 because it was acquired in December. We're a March year end, so we are discounting it down to get to that net present value of future lease payments. So there's no retrospective restatement, whereas where it was previously classified as an operating lease. So what we're doing here, very vanilla, we're saying that the right of use assets, there is no expectations on sort of quirks in that right of use asset. So we're not saying that huge dilapidations. We're not saying that there are other sort of costs to bring in. It's already there. It's already in lease. So we brought it in. So with the right of use asset at the time of the lease liability adjusted at the prepaid accrued lease payments. So we are bringing it in at that 563,107. So what are we doing initially as at the 1st of April 2026? We're gonna bring it on balance sheet, the right of use asset and the lease liability. So that is the net present value, and then we've got the rights of use asset. So in theory, net in our balance sheet, no changes. Gross, though, we've suddenly got, as of that date, 550,000, 563,000, in fact, new assets and new liabilities. So we've suddenly got a hugely inflated balance sheet. So that is what it's going to look like. But that is, net impact is going to be zero. So the right of use asset is then depreciated, as we would expect. So there's no reasonable certainty that the lessee will obtain ownership at the end of the lease term. The asset is fully depreciated over the shorter of the lease term and its useful economic life. So it's aligned to your normal fixed assets. You know, what are you depreciating over? Again, you will need to document your consideration, your policies around that. So the lessee must carry out an assessment each reporting date as whether the right of use asset is impaired. So this right of use asset is treated now in a very, very similar way to any of your assets. You've got to consider impairment at the end of the each year, and you'll depreciate it over that lower of the shorter of the lease term and the useful economic life. Likelihood, hopefully, in most cases, it's going to be the lease term. So that's what we're kind of doing. So for the purposes of our example here, assuming a 4-year useful economic life, the right of use asset is depreciated at £140,000. I know there's nuance in the 3 months, but we're just keeping this as a high level worked example. So effectively, you will expect every year at 563 now, we've got that asset on the balance sheet, we will depreciate it. So it will be the depreciation charge of the 140, and we will have that accumulated depreciation will be offsetting that asset in the balance sheet by the £140,000. What does this mean to sort of going back where we sort of started? Where does it slightly start to move away from matching scenarios? So here we can the P&L and how it's sort of put through. There is the depreciation expense of that right of use asset is being depreciated over the 4-year term. That's the £140,000. But we've got this interest expense. What was that? So casting our minds back, at the initial, we've got the 563,107. We've got the 5 matching liability and asset. The right of use asset, relatively straightforward. We are moving that down at a set 4-year period, depreciating it over the term of the lease effectively. So that's pretty much straightforward. That's consistent. You can see it in the P&L, and you can see it sort of winding down that right of use asset. The lease liability, let's not forget, we've discounted that down to the 563, and then we're going to reduce that liability by the cash payments we've made, the 180. But we've got to unwind that lease liability. So we've got to bring that back up over that period of time to the full liability, to the full amounts that we had to pay. So here you're unwinding it. You can see the cash outflows, the 180, 180, 180, and then the 9 months to the 135. But the liability is also being increased and swapped by the unwinding of the finance sort of interest now. So you will then see year 1 suddenly right of use asset and lease liability do not match. You know, there is suddenly a net liability situation here. So this is the potential implications, you know, depending on your business, depending on the number of leases and things, depending on the size of those leases. This then could have quite an impact on the balance sheet over the period of the lease as it's unwound and as those payments are made, because after that initial sort of piece, the right of use asset and the lease liability may therefore change and may not match. The other thing to think about, and we'll sort of get to those pieces, is that unwinding is coming in as an interest expense. Does that impact you in potentially loan covenants and potentially in some of the KPIs and then reporting, because it's not coming through as just an operating expense, it's not coming through as depreciation. There is a finance and interest expense now coming through. So as at the 31st of March 2027, the lease liability is split between the portion falling due within 1 year and the portion falling due. You know, that was the sort of the old system. What we're trying to show here is what are those differences between old FRS 102 and new FRS 102, and how does that look and how does that different? So that depreciation charge, on the left hand side here, we've got the impact of the new standard. We've got depreciation charge, we've got finance cost, we've got a total impact of 185. So we've got an increase hit, I suppose, to the P&L in that first year. And under old FRS 102, we'd have the lease rental expense of £180,000. That's what it would be. So it's a very, that might have gone into your admin expenses or other operating expenses. We've now got depreciation, we've got finance cost with a £5,000 impact. As I say, in this scenario, £5,000, not the end of the world necessarily, but we've got it could increase quite significantly depending on the type of operating leases that you currently have. So what does that mean? You've got the reduction in cash of 180 on the balance sheet. You've got the right of use asset which is the 422, and then you've got the lease liability split between current and non-current liability on your balance sheet, on the face of your balance sheet. So all of a sudden your net liabilities, your net current liabilities are quite significantly higher. You've got that current liability of 145 here. You don't have that similar current asset. You've got that, you've got the right of use assets sort of sitting there in a sort of long-term asset point. So again, what does this impact, and how does this impact your balance sheet, your KPIs? Does this impact you in other ways beyond financial reporting at the year end? All of these calculations, as I say, some businesses this could really impact KPIs. Could this impact sort of wider pieces? And we'll just touch on those just at the end. So with 4 minutes sort of to go, I think we'll just refresh ourselves. We've got the lease right of use assets and lease liabilities can be presented either separately on the face of the balance sheet or broken down in the notes. So it's that sort of classic. You can have a new line for right of use assets in your balance sheet, or it can form part of your wider notes in the background. So you have a choice there on the front. You've got to describe the leasing arrangements. As I say, there's those expenses relating to interest, short-term leases, low value assets. They're going to be disclosed at the back, so you're going to have to explain them. So you're going to have to keep sort of track on them as well. Still, the sort of idea of outflows for leases for cash purposes, and if you have taken practical expedience, you have to put that in your accounting policies, disclose what those are, and create there. So there's quite a lot of disclosure. We've got the reconciliation of right of use assets as well. So it's quite a lot there. I think some of the practical challenges, what does this mean, is updating internal accounting systems. There is now not a simple unwind of an operating lease and just doing a 1 year. That's going to be, you've got your finance interest, you've got your depreciation, you've got your assets and liabilities, you've got current, non-current liabilities potentially. How is your system set up for that? Was it previously automated and therefore easy to track? Do you have to think about changing those? How are you going to go about that? Have you got capacity in your team to do it? Do you have the skill set in the team to do it? So thinking about those kind of things. The full assessment of the leases, as hopefully I've demonstrated over the last sort of hour, there are a huge amount of judgments at every step of the way. You have to make sure you are happy with them. You have to have documented those. You don't leave this to the last minute. If you've got lots of leases, you have to go back through, and you have to also think about the ones that maybe actually there is an asset or a contract that's implicit in something else that you might not have thought about previously. So there's a lot of possible work to be done, again, depending on the business and and your operating leases at the moment. The impact of assets on the balance sheet could impact your size limits. So you could move up a size depending on your operating leases. As I say, the way it is then presented, the net current liabilities could increase. That could impact KPIs. That could impact loan covenants. How are you remunerating? Is there a potentially with the finance costs as well, similar idea, but obviously bonus packages, remuneration and things in the business could be impacted. Um, Stakeholders might not be aware, and suddenly it's going to be quite a big change, having large amounts of balance sheet and income on there. So it could be huge amounts. There's a lot to think about. Do not leave it to December. If you're a December year end, you do need to think about it, because it could impact how you're discussing. If you're looking to sell the business, if you're looking for financing, it can impact all of those things. So I think my request will be running some more of these, looking at revenue, looking at other sort of pieces. Do start thinking about it. If you need support, do reach out. We can help you on those sort of pieces. Don't underestimate the amount of work that's going to be needed. Any questions, as I say, it does take quite a long time to try and work through this. Please do ask any questions. Do send any questions in. Contact your local hubs if you've got them, or I'm more than happy to answer any questions. So do just email me or get in touch with us. We will be putting these up on the website, sending around slides as well. So hopefully that will be there as a refresher, and we'll probably be running a refresher course later in, say, September, October time as well. Just leaves me to say it's 10 o'clock. Thank you very much for joining. We will be holding more of these as the year goes on. Please do join. As I say, they sneakily go to your CPD as well. So hopefully they're informative, and we'll catch you on the next one.